Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 70. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, income tax day is coming, whether we like it or not, and I want to do an episode similar to one we did a few months ago on estate planning, this time talking about taxes. If you're watching this on YouTube, quick reminder, hit that subscribe button for all the latest content from us. We're also available on Apple and Spotify. The topic for today, Peter, 10 ways to save on your taxes. So here we go. Number one, max out your retirement accounts. And I know this is a huge one for you. It's often the first thing you tell people to do. Figure out what that 401k contribution match is and make sure you get there.
That's right. Like if you've got, the only thing I will say is if you've got credit card debt, that's probably the only thing you should ever do before is pay that down before you start to fund these. But man, retirement plans are incredible opportunities. Different people eligible for different things. Some people are self-employed. Some people are not employed. Some people are employed by companies that match, some that don't. But the bottom line is you want to make sure you understand your retirement plan options. If you work for an employer that has a match, they might say, hey, the first couple percent you put in, we'll match it. That's 100% rate of return on your money. So if you have a match in your plan, you're not maxing it out, pause this podcast, go straight to HR or finance and sign up for that plan and at least contribute up to the match. But every dollar you contribute to these 401k, 403bs that are set up traditionally, you're getting an income tax deduction today, and it is growing tax-free, and in some cases, you're getting a match. A lot of great opportunity here. Some of these plans have an option where you can elect to use after-tax dollars, and the money grows tax-free and comes out tax-free. It's worth a short conversation with your financial advisor or CPA to look at, well, what plans are available to me, and which ones should I be doing, and making sure you're contributing.
Awesome. So assuming your employer offers, this is a question I get all the time, a 401k with both a Roth, which now almost all of them do, and a traditional option, what do you tell people in terms of which one should you choose?
This really has a lot to do with what's your income tax bracket today, where you may or may not get a deduction depending on which plan you choose. What will your income tax bracket be in retirement when you're taking money out? So this is actually a very big decision that can be easily answered by the advisor or accountant that you're working with that understands those two sides of the equation that impact this decision.
Right. And what it tends to be, Peter, is earlier in your career, you have a lower bracket. And so for a lot of people, you're probably leaning more towards the Roth end of the spectrum earlier in your career, later in your career, the opposite. But it also involves in trying to predict what the future tax rate is going to be, which is, of course, impossible. You and I don't think it's probably going to go down, but who knows? Anything could happen from here. And so what a lot of people do, and I don't think it's a terrible idea, once you're into your career and you're in a higher tax bracket, you could split the difference, right? Do half in the traditional, half in the Roth, and that way you're covered under both scenarios and you're kind of minimizing your regret.
Yeah, I mean, the fact that we're talking about this in this way, I just have to go on a mini rant that it is terrible how complicated Congress has made this. 401k, Roth 401k, IRA, Roth IRA, 403b, all these different plans with all these different rules, and you're expecting somebody to be able to figure this out. It's way more complicated than it needs to be. And really what would be great in the United States is if they threw 100% of this out the window and had one national plan available to everybody. Very clear how it works. Everyone can understand it.
That's wishful thinking, Peter, because as we know, the tax code only gets more and more complicated as we go along, and every year there's new changes and things. But in terms of the Roth, and I know you talk about early in your career, it's, try to fund it. When you're working, you have small jobs. Even as a teenager, you can start funding the Roth. And I just want to illustrate here really the huge benefit of picking that Roth versus just keeping money in the taxable account. I think this is lost on people because you don't see this growth. You just see yeah, I may have saved a little bit this year, but over time, if you're putting the max into the Roth every year, starting at age 25 until you're 65, you're almost looking at a $900,000 difference versus opposed to if you had just been putting it in a taxable account. And this is assuming an 8% growth rate and 25% marginal tax rate. So the advantage here is very, very big. And the earlier you start, the bigger the advantage is going to be. Let's go to number 2 here. Use an HSA like a Stealth IRA. And for those of you who aren't familiar with an HSA, get familiar with it. If you have a high deductible insurance plan, which many people do nowadays, is what I have, you're eligible to fund this HSA. And Peter, it's really one of the few examples we can point to, the only example I can think of where you're getting a triple tax advantage. You're not only getting that deferred growth, you're getting a deduction up front. It grows tax free. And if you use it for medical expenses, you're also getting no tax on that, which is pretty incredible.
Yeah, absolutely incredible deal. Tremendous advantage for people that are able to, that have that high deductible plan. It's it's also like a stealth Roth IRA, right? So it's got so many incredible advantages to it.
Yeah, just a few tips here. You have to be pretty organized, Peter. I'm sure you're this organized, but most people, this would probably be difficult. So you could fund it every year. So you could, if you're an individual, 4,400, family 8,750. This is for 2026, and you can incur medical expenses that year, but you don't have to withdraw in the year you incur it. You can. There's no really time limit. You could do it years into the future and let that compound in the account. And you have investment options like stocks, many different options, similar, to a 401k that you can invest in and let this thing compound over time. And then years down the road, take the withdrawals for those medical expenses. Again, you have to be very organized. And in terms of like the penalty here, the only downside, Peter, you have a lot of money left into this, and you're over 65. Well, you can then take it out without taking any penalty, and it's just taxed as ordinary income. If you leave it to your spouse, it'll be tax free, and they could use it as an HSA. And what a lot of people don't know, because they might think, oh, later I'm going to be covered under Medicare. I probably won't have a lot of medical expenses. Well, a lot of people are going to be paying premiums, Part B, Part C, Part D, in terms of Medicare, and you can actually use the HSA for that. So a huge, huge benefit in terms of the tax treatment, and really the compounding can be enormous. And as you said, it's a stealth IRA in a sense, with the additional benefit that you're getting an upfront deduction. Okay, let's talk about number 3 here. Put assets in the optimal accounts. And this is another one, Peter, really, of course, depends on your personal tax situation. But in general, I think the idea here is pretty simple. You're favoring assets like stocks in your taxable accounts, which are going to have the advantage of long-term capital gains treatment, and things like bonds and REITs that distribute a lot of interest income that's taxed at ordinary interest rates. Well, all else equal, it would be better to hold those in a tax-deferred account.
Yeah, it really is that simple, but most people don't do it. Most people, if they have a taxable account and they're supposed to be 70% stocks and 30 bonds, that's what they do in the taxable account. And then they go to their retirement plan at work and they choose a portfolio that's 70% stock and 30% bonds. And instead, if they just looked at it as one big portfolio, their taxable account would be heavily overweighted to stocks. The retirement account would be heavily overweighted to bonds. The overall ownership of stocks and bonds is the same. But because you're not paying taxes on the income on the taxable bonds, you have a much larger after-tax return. And over the course of your life, this couple percentage points a year will make an enormous difference. So to me, this is the easiest thing that's left on the table by the vast majority of people.
Absolutely. And there's also an estate planning component to this, Peter. And as some people might know, there's a thing called a stepped up basis. And so if you have an appreciated stock position, you pass it on to your heirs, they're going to get the stepped up basis on that and potentially not have to pay any of the gains as well.
That's right.
So let's go to number 4 here. Harvest your losses to offset gains. The market is in a little bit of a pullback here, Peter. I know at Creative Planning, we're doing this all the time, but in the past few weeks, I'm sure we're doing a lot more of this for clients. And it's pretty simple. You have a stock position, it goes down, you could sell it, take a loss, buy it back in 30 days, or buy something similar immediately. And now you're booking that loss, which you could use to offset capital gains or up to $3,000 of ordinary income, which to me, Peter, is pretty incredible. It's been 3,000 for as long as I can remember. They
Yeah.
don't index that for inflation. But in terms of building up the losses for future gains, this is something I know you deal with a lot in terms of your business owner, you have a real estate sale or appreciated single stock. This could be pretty meaningful using this tax loss harvesting strategy.
Yeah, I think that this is a lot of free money left on the table by a lot of people. It's probably not a stretch to say creative planning does this at a scale that no other RA in the United States does, and basically, it's really straightforward, like you say. So if you've got $100,000 and it's in the S&P 500, but you own all 500 stocks, Visa goes down, you buy Mastercard. Conoco goes down, you buy ExxonMobil, and so on. At the end of the year, you get about the stock market return. So if last year the S&P was up 18%, you're up around 18%. This year it's down 7%, you're down around 7%. But on your tax return, you've got these losses. And so later in life, when you sell stocks to fund retirement, you won't pay any taxes for a long period of time. Or you might sell a rental property to gain or a business at a gain, and you get to deduct all these losses, even though you didn't actually lose money. You stayed engaged in the market the whole time. Over a long period of time, the market has gone up for you. But on your tax return, you've accumulated these losses that carry forward for forever until you use them until your death. You have all the way to your death to use them. Incredible advantage that most people should be looking at.
And what about this enhanced direct indexing, Peter? Is this something that we're doing more of at creative planning? What's the benefit of thinking about something like this?
So this is kind of taking it next level. Somebody, very smart came along and said, "Hey, this is really working out very well. What if we had more stocks to harvest and we could harvest in up or down markets?" So you got $1 million portfolio, and instead of just having 1 million in the S&P 500, you borrow against that account, and now you might have 1,900,000 to be able to invest. But you take some of that money and you invest it long, which means you want the stocks to go up, and some of it you invest with stocks short, meaning you make money if they go down. Basically, this means you've got almost double the amount of assets in the market. That obviously gives you more tax loss harvesting opportunity, and you can tax loss harvest whether the market's going up or down. So this really amplifies the losses. At the end of a year, your variance will be higher than it is with direct indexing. Instead of being very close to the index, you could be a couple percentage points off. But it can go either way. You might be a little ahead of the index, a little behind, but in general, you're going to get around the market return. But the losses on your tax return will be much, much, much greater. This is a strategy used by a lot of people that are having liquidity events, selling a business, selling a concentrated position, things like that.
All right, let's go to number 5 here. Hold for long-term tax rates. We always encourage long-term holding, Peter, because it increases your odds of success. It increases your odds of having a huge lump sum at the end, because the short term, the market's very unpredictable. But the tax code also rewards this type of patience. If you're holding for less than a year, you're paying ordinary income tax rates at the federal level, 37%. If you add on the state, places like California, you're talking about over 50% in total taxes if you sell it in less than a year. And if you hold it for greater than a year, depending on your income, you might pay 0%. If your income's low enough, 15% or 20%. So a huge advantage to simply holding for that 1 year period, really not acting like most hedge funds act like in
Right.
terms of trading in and out of the stock market.
Yeah, self-explanatory. If you're selling something under a year, there needs to be a really, really compelling reason.
Yeah, and the best reason would be to harvest that loss. It wouldn't be
Yeah.
to take the gain. Okay, let's talk about number 6 here. Donate appreciated assets instead of cash. So you want to donate to a charity, Peter. Some people might think, well, I'll just write a check to the charity. That's not actually the best way to do it, is it?
No, I mean, over 90% of charitable giving is done with cash, and it's actually the worst way to give. If you give cash, the good news is you're helping a charity and you're getting an income tax deduction. So if you're in the 30% bracket and you give $1, it really costs you 70 cents. But instead, you want to give your most appreciated asset. So let's say you had bought Apple stock a long time ago, it's gone up, you donate the Apple stock, you get the same income tax deduction, but the charity gets to sell the Apple stock without paying any taxes. So no one pays any capital gains tax, and you no longer have that embedded capital gains tax you were going to have to pay someday. If you loved the Apple stock, what you do is you take the cash you were going to give the charity and instead buy more Apple stock. And what that does is allow you to have the same position in Apple, but now the basis is higher. It's what you paid for it today. You've given your original Apple stock to the charity. You've gotten the capital gains break. You've got the income tax deduction. You've used the cash you were going to give to the charity to replace the Apple stock. And now there's no embedded capital gain there.
Yeah, and just walking through quick numbers using actual dollars here. Let's say you have Apple stock 25,000, Peter. Now it's appreciated to 40,000. Instead of writing a check for 40,000, you gift the 40,000 to the charity. You're getting that as a deduction and you're saving the taxes on that $15,000 gain, which would be at the federal level around 3570. So it's a win-win for everybody. Think about gifting an appreciated asset versus cash. And if you do give cash, and that's fine too, Peter, the good news for 2026 and going forward is under the new bill that was passed last year, you can now deduct that above the line. So you don't have to be an itemized filer, which many people don't itemize now because the standard deduction is so high. If you're single, you can contribute about $1,000 and get an above the line deduction. If you're married, finally, jointly, $2,000. And so this is just an additional thing to remember for 2026. Don't throw out those charitable contributions because you think you're taking the standard reduction. Now you can do both. Take that standard deduction and get this above line deduction as well. Let's go to number 7 here. Consider a Roth conversion at the right time. And how you're going to figure what the right time is, you're going to work with a tax planning expert or your advisor. Because there's a lot of different things to consider, Peter, before you figure out if it makes sense.
Right. So basically what we're doing is we're converting from an IRA where you got a tax deduction and it's growing tax-free, but you're going to pay income taxes when it comes out. We are converting to a Roth where when you take the money out, you won't pay income taxes. Well, when you convert, you're going to pay income taxes over a period of time on the conversion. So this can make sense. First, we have to have a future state where we expect the tax bracket higher than today. Second, we want to convert in a low income year. So if you've got a year where you have very, very low income and you convert, you're paying the lower income tax rate on the conversion. And then, of course, we're going to have to pay that tax. We don't want to use the money in the fund that's growing tax-free to pay the tax. So you need to be in a position where you've got cash outside to pay that tax. A lot of people do this during market drops. The market drops, the account is lower. So when you convert it, obviously a smaller amount has smaller tax. And then hopefully the market does what it always has done and recovers at some point. And you've got this full Roth IRA, but you converted it when it had dropped. So there's a few considerations here. The key here, though, is we want to convert in a year where the taxes will be the lowest.
Absolutely. And why would you want to convert? Well, the Roth IRA has a lot of benefits that a traditional doesn't, in terms of you don't have to take that required minimum distribution. So you could just let it grow until you pass and give it to your heirs, and then they will have to take it out and pay tax on it over time. So it's really just deferring that tax that you have to pay even further. And that's the primary reason people do it, is really for estate planning purposes.
Right.
Okay, let's go to number 8 here. Use 529 plans for tax-free growth. Peter, as we know, education costs continue to go up, so 529 plans becoming more and more important. And the good news is there's a lot of benefits with the 529. And last year, under the new bill that was passed, they added to the things that you could use in terms of those benefits. It used to just be higher education. Now, Peter, you can use it for K through 12, up to $20,000 per year, tutoring, test programs, or vocational programs. It's really, really been a huge expansion in terms of what you can use the 529 funding for.
Yeah, I mean, this is a great benefit. You're able to contribute to a plan. It grows tax free, comes out tax free, gazillion ways to get the money out. Some states offer an income tax deduction. If one kid doesn't use it, you can move it to another kid. If they don't use it for college, you can use it for other things. It's got a lot of flexibility. Also overly complicated, but that's a whole other story. But if you've got people that you're thinking about paying for their education, kids or someone else, definitely talk to your advisor about a 529. A lot of great benefits here.
100%. And in terms of estate planning, this comes up again, Peter, in terms of there's a maximum gift that you could give. It's called an annual exclusion, 19,000 per individual, 38,000 for a couple. That tends to go up every single year. And if you fund this 529, you're actually allowed to do 5 years upfront. So do a total of 190,000 upfront for a beneficiary without triggering federal estate tax. And another new wrinkle in terms of complication that they just added last year, but it's actually a good thing. If you have unused funds in the 529 plan and you have it for a certain number of years, there's a lot of different rules, Peter, but they're now allowing you to roll up to 35,000 into a Roth IRA. So an additional benefit there where you don't have to worry, am I going to have the academic expenses? Well, even if you don't, you could use it. Many people will be able to use it for a Roth IRA for that beneficiary. Okay, let's go to number 9 here. Time your income and deductions strategically. And we don't have control over everything in terms of the tax of income and deductions, but some things we do have control over, Peter, and you could really shift things around to save on taxes, but it requires a little bit of planning.
Yeah, a lot of this is, in one year, a deduction might be more valuable to you than the other. And if that's the case, and you've got this piece of equipment or something that you're going to buy, and it doesn't make a difference if you buy it in December or January, you want to put it in the year where you're going to get the biggest tax break, whether it's buying a big SUV or a plane or buying a printer or a phone that's deductible. The timing, you want to bundle these together where you're getting the biggest break possible. You would like to do it in a year where your income is the highest possible. So sometimes you're delaying, sometimes you're accelerating, but you want to get the expenses in the best year possible to get the biggest break. If you're looking at selling a stock that's concentrated position, or a rental property that's got a big gain, or your business or anything like that, where there's going to be a big tax, well, if you do it in January, it's much better than doing it at the end of the year. And the reason is, if you do it in January, we've got all the way till the following April to pay the taxes. So we have all sorts of time to utilize some strategies like you and I talked about earlier to get out of some of these capital gains taxes. If you have the sale at the end of the year, no time to do any planning at all. You're going to pay the full tax. And I think another one that I think is really powerful, we do this with our clients all the time at Creative Planning, is people tend to do charitable giving as the opportunities present themselves. Instead, you can set up a donor advised fund, make a big charitable gift of your money to that fund in the year where you get the biggest tax break, and then use that fund to give to charities over the course of the next however many years. There's no tax break you get when the money goes from the donor advised fund out to charities, because you already got it when you bundled all your gifts into the donor advised fund in the first place. This allows you to get the biggest tax break possible and give exactly what you were going to give before. You're not giving more, you're not giving less. You're just getting a bigger tax break, which allows you to have more money for yourself or give more to charity.
Awesome. So let's go to number 10 here. Work with a proactive tax planner, not just a filer. And a lot of people are going to file their taxes in the next few weeks, Peter, and not think about it for the next year. But really, the benefit of working with someone who's a planner at Creative Planning, we have hundreds of CPAs that are working with planners, working with advisors to try to come up with a holistic picture here of everything and try to be strategic and proactive about minimizing taxes going forward.
Yeah, a lot of people, they're tax preparers, not tax strategists. And a preparer, where you go, hey, here's all my stuff, prepare my taxes. Basically, you're a historian at that point, right? You're just taking the information, you're putting it in the computer, and you're saying, here's what you owe. You need to be meeting ahead of time. So if taxes are due in April, you want to be meeting in the fourth quarter or the third quarter and talking about, well, here's what's going on. Should I delay expenses? Should I accelerate expenses? Should I delay revenue? Should I accelerate revenue? Should I make a charitable gift this year, or should I wait till next year? All these conversations need to happen before the end of the year, right? So you really want to have a strategist that's helping you think through these things. Makes a very, very big difference. Repeated year over year over year can be a substantial difference in your family wealth.
Great. So there you have it. 10 ways to save on your taxes. Get to work. And before we end, Peter, just want to mention to everyone, you have an updated version of Money Simplified now available. I'm going to have the links in the show notes. Peter, what are the updates? Tell everyone about this book if they're not familiar with it.
Yeah, so round one did really well. Lots of new charts. A lot of charts have been updated to be more current, reflect what's happened more recently. But I like the way this tells a story. It really covers very advanced, simple topics and very advanced topics, I think, very, very clearly. And I hope the new version 2.0 resonates.
Awesome. Great coffee table book. A lot of great visuals in there. Really timeless investing, planning concepts that really you can take with you through your whole investing career and give it to a young person in your life. It's really going to benefit them. All right. We'll end it right there. Thank you, everyone, for watching Signal or Noise. Once again, if you're watching this on YouTube, hit that subscribe button for all the latest content from us. And Peter and I will see you next time on Signal or Noise.